Hi, Mohnish. Welcome.
Great to be with EO Delhi. It's wonderful. And
EO
thanks
Gurgaon.
EO Gurgaon, sorry. So thanks for hosting me.
Thank you very much. So I think Mudit is just joining and supposed to do a quick intro. We're so happy to have you. We're eagerly looking forward to this event. And along with EO Gurgaon, we have various other members of the EO South Asia community from various chapters joining us today.
Okay, that's wonderful.
Yeah, Mudit, do you want to take it on?
Yeah, hi. Hi, everyone, and welcome to EO Gurgaon's first virtual learning event of the year. In attendance today are the members and spouses from EO Gurgaon. I am Mudit Tandon, the Learning Chair. Additionally, we have also specially invited members of the My EO Investments Club, called the FinServe, which has members from all over EO South Asia. The champion of the FinServe Club, Ayush Manjal, will also join me in asking questions at the end of the event. Today, we have the privilege to speak with Mohnish Pabrai. Mohnish is the founder and managing partner of the Pabrai Investment Funds, the founder and CEO of the Dhandho Funds, and the author of the Dhandho Investor and Mosaic Perspectives on Investing. He is also the founder and chairman of the Dakshina Foundation. But to truly give you a flavor of who Mohnish is, I will quote his friend Guy Spear from The Education of a Value Investor, page 63, where he says, Mohnish has a colorful background. He's the grandson of a well-known magician and the son of a businessman who's had at least as many failures as successes. Born in 1964, Mohnish grew up in Mumbai, Delhi, and Dubai, and arrived in the US as a penniless student in the 1980s. He went on to build an IT consulting and servicing business called TransTech, which he financed with $70,000 in credit card debt and about $30,000 from his 401k. TransTech's revenues grew to $20 million, and he ultimately sold the company for $6 million. Mohnish discovered Warren Buffett and value investing through the Lowenstein biography and by studying Berkshire's annual letters to shareholders. He was so captivated that in 1999, he set up his own investment firm. The returns of the Pabrai funds have been superb. In September 2013, Forbes published an article headlined, How Mohnish Pabrai Crushed the Market by 1,100% since 2000. Mohnish will speak to us for a short while, and then we have some pre-prepared questions. After that, time permitting, we will take some questions from the audience. If you have any questions, please type them in the chat box. Mohnish, thank you so much for being here with us. The floor is yours.
Well, thank you. Thank you, Mudit. It's a pleasure and honor to speak to EO Gurgaon. And I've been a deep admirer of EO for a very long time. And I've also been a member of YPO now for almost 26 years. So it's been a long time. I used to have a head full of hair when I joined YPO. And the impact YPO has had with Forum, et cetera, which a lot of you are familiar with, has been transformational. There wouldn't have been a Pabrai funds without my forum. There wouldn't have been a Dakshina Foundation. So and a lot of impacts on my personal life, which have been very positive. I'm always very excited to speak to entrepreneurs and business leaders because job creation and such is the key to shared prosperity for a large swath of the population. And it all starts with entrepreneur having an impossible dream and then taking it from there. Just a few remarks before we go to what you have on your mind. Buffett has a quote. He says, I'm a better investor because I'm a businessman, and I'm a better businessman because I'm an investor. There's a lot of cross-pollination between being a good investor and being a good business leader. And most of you spend most of your time running and managing your various businesses. And actually, if you have a little better understanding of how investing works and how capital allocation works, it can actually be very useful to you on how you run your business. And one of the key tenets of capitalism is that capitalism is creative destruction. It's basically very brutal. So if you end up with some mousetrap that is doing really well, growing well, high returns on capital and so on, a lot of people will try to take that away from you. And usually they will succeed. So it is in the nature of capitalism that pretty much almost every business that will eventually disappear. If you look at the number of businesses that were around 100 years from now, 100 years back, which are still with us, it's a very small number. If you go further back 200-300 years, it's almost close to zero. There's one hotel in Japan that has been in business for 700 years in the same family, like a 40-room hotel somewhere in northern Japan. And that's very unusual to have that many generations be able to keep a business solvent and so on. But most businesses may not even get past 5 years or 2 years or 1 year after they start. Very few will make it past 10 years and even fewer a couple of decades and so on. And even the ones that survive, the issue is that if they are any good, they will attract a lot of competition. And eventually, for most businesses, the competitive advantage tends to get diminished or closed over time. That's the nature of capitalism. But what we also end up with is we end up with some quirks, which sometimes are not predictable. And these quirks, kind of accidents of history, brands get built. And so we have with us some businesses like Coca-Cola or American Express or Pepsi or Visa and so on, which have endured and lasted for a very long time. And many of these businesses, when they started, the founders couldn't see that. They were just trying to put one foot in front of the other. So accidentally, a lot of these things get built and get sustained and so on. So one of the things that I think that can be very useful to entrepreneurs and CEOs is that in your business, when you are looking at adding capital or allocating some of the earnings into growth or into expansion, it should be fairly apparent what the likely returns are expected to be for your endeavor. You're putting up some plant. If you're in the retail business, you're opening some retail stores or whatever. So you can clearly see, because you've had past history, that, okay, this plant is going to cost me 100 crores or 50 crores. And I'll borrow some of it. And maybe there's a certain equity that goes in, and you can get a sense of what the return profile on that equity is going to be. And if that return profile is not attractive. So what happens with most businesses is they're on a treadmill. So someone's in the cement business and they have a bunch of cement plants, and all they can think about when the cash comes in is, let's expand the capacity, let's build another plant, and so on and so forth. Because there's nothing else they know how to do. That's all they know how to do. And they just go down that path. And someone in the cement business in India had told me that every 10 years we have 2 great years or 3 great years. So it's a tough business, it's a cyclical business and so on. But if you add a couple, I would say, mental model to the way you think about allocating capital. So the first mental model is that if you're not getting at least 15, 20, 25% return on incremental capital going into your business, it may not be worth thinking about it. I'm just saying you might be able to get close to double digits with debt instruments and such. So really, I would say that the bar should be close to around 20% at a minimum in terms of the incremental return. So if you're going to invest 20 crores into your business, you should be able to see 4 or 5 crores come out of it. The second is that a hallmark of a great business is that it does well, high returns on equity, without much use of leverage. So that's the second thing, is to consider whether you need to have a lot of leverage to make the numbers work. And that's usually a red flag. So what do you do if you're in the cement business and you are looking at a new plant and the plant's going to give you like low teens or 15%? And those are projections which can be off. So it could actually end up being 9% as well. It could be much lower than what you think. And we as entrepreneurs, we're always optimistic. So we should always discount the numbers we ourselves come up with. So what do you do? What's your plan B? So I would say that there are 2 things that if you add to your arsenal can be very helpful to you. One is that you always have the option to put the cash into a low-cost index fund. So if you don't have a good way to grow capital significantly in your business, you could use the business as a cash cow and buy like a mid-cap index or something, a small cap index or something, multi-cap, whatever, and just allow the money there as the cash is coming, it could go into, and those may get to double digits and you don't have to do much work with it and so on and so forth. That's one approach you could take. And because it's going in over time, it gets risk adjusted as it goes along because it's not going in at one point in time, it's going in kind of dollar cost average over time or rupee cost averaged. The second framework, which is probably likely to give you better results, but also would require a significant change in mindset, and very few companies can do this, is to be creative about planting new seeds. And so what I mean by that is there are companies, it's a small minority of companies, which have the ability to enter new businesses and or enter adjacent businesses. So here, what I would say is that what you want to do is you want to keep the bet sizes really small. So if you can think of areas or opportunities outside your core business, you're in the cement business, you know how to run plants, they could be somewhat of a different take on a little bit of different type of manufacturing that may be less commodity-like, and you could make some small investment and use those small investments as the tuition bill to learn. And since the invested capital is small, if the return is low or even if it disappears, it doesn't work, it's not the end of the world because you didn't put a lot of money in. And you could do a number of these serial bets. So you could try one that doesn't work. Okay, let's try something else, doesn't work. And you could keep going. And the thing about the whole investing business, I mean, the whole entrepreneurship and capitalism is that the payoffs are asymmetric. So the maximum you can lose is what you put in. The maximum you can win could be 50x, 100x, 20x, 10x. So because of that asymmetry, it's worth pursuing that. And if and when you find something like that, then once you have something working and now you have two engines, you can gradually take the foot off one accelerator and pump it on the other one, whichever one has better returns on capital and better business and so on and so forth. Another approach you can take, which would take some work, but you could look at that, is, in my opinion, control is overrated. So a lot of entrepreneurs think that when they control their business, they control their destiny. And actually, really, the market controls you. You don't control anything. Your competitors control you, and your customers control you. Your employees control you. A lot of people control you. And so I would say one of the geniuses, I mean, it was an aha moment for me when I first heard about Warren Buffett in '94, about like 28 years ago. I was at that time running my IT business. It was just like 3 years old at that time. And it was growing pretty rapidly. We were growing like maybe 70, 80% a year. And when I read about Buffett, so when you run your own business, what happens is you will spend maybe 3 or 4% of your time on figuring out strategy and direction. And then 96, 97, 98% of time goes into all the blocking and tackling to make that strategy happen. And so there's a lot of heavy lifting to make, what ideas you have come to reality and work and so on. And in my case, what I found is that I really enjoyed the 3 or 4% of time a lot more than the 96%. I think the 96% was fine. It was fun, especially it was fun when I was doing it for the first time. But really what I really liked was the 3, 4%. And in my IT business, what was happening is every 3 or 4 years, probably what would happen every 3 years is that whatever focus we had tended to get commoditized. More companies came into that area. The margins started to go down and so on. So I had to constantly kind of reinvent new practices and new directions within the business that were newer and had higher margins. And whenever I was doing this exercise of trying to figure that out, I really enjoyed that time. And then, of course, I had to work on making that happen, which was pretty good, but not as enjoyable as the pure strategy. When I first encountered Buffett and I was reading about him, what I realized is basically what he had done is that he had taken that 4% of time and expanded it to 80%. And instead of doing the heavy lifting himself, he spent all his time figuring out which businesses were great and which businesses were mispriced and which businesses had great business models. And then he would make passive investments into those businesses. So he didn't control those businesses, like he made an investment in Coke, or he made an investment in American Express, or he bought the railroad and so on. So a railroad, of course, they own it completely, but he bought it like an intact business, is already running with management and all of that. And I said, wow, this is awesome that I could take 4% to 80%. And I don't have to do the heavy lifting. I don't have to have any employees. If you don't have any employees, you have no problems. And I don't have to really do much. And I said, this is the holy grail. I'm going to go down this path. And so that's really what drew me into investing, because it's the same part of the brain. So actually, entrepreneurs and business leaders are already set up to be great investors, because the part of your brain you use for that 3-4% of the time is the same part of the brain that gets used when you're trying to figure out which company or which business or which stock you should buy or sell and so on. So the frameworks between the two are very similar. They use the same brain cells. And that's why Buffett says, I'm a better businessman because I'm an investor. I'm a better investor because I'm a businessman. So when I heard about Buffett in 94 and I read everything I could about him, I said, okay, what I'm going to do is I had sold a small portion of my business then. After taxes, I had about $1 million, which I really didn't need. The business didn't need capital. I said, okay, I'll take this million. I'll start investing it into public equities. And I want to see how I do, what the results are. And I want to see how I enjoy this. So I started spending like 10, 15, 20 hours a week on studying businesses and making some investments and so on. And I think from 95 to 2000, that million became like 13 million. Of course, from 95 to 2000, we also had a good bull market, which was helpful. So I said, well done, Mohnish, very well done. And at the same time, I was running my IT business. And in some years, I was making more money alone, part-time doing investing, than my business was making with 70, 80 people. Like I said, okay, there's something wrong with this picture here. So eventually what I did in 99 is I was losing interest as the company got bigger. My job was turning more into an HR job. I was just herding cats, about 200 people or so. And I really didn't enjoy running the company. And usually when I didn't enjoy what I was doing, I just resigned, find something else to do. I had two rules. If I was not excited to go to work on Monday morning, rule number one was don't go to work. And rule number two was hit the reset button. And so when I was losing interest in the IT business in 99, there was no one to resign to. I owned the company. It was a monster I had created. All the problems were because of me. And so I felt trapped. And then my forum, my YPO forum told the moderator, I need to really present because I'm not in good shape here. And I told them, listen, I have no interest in this company. I own this company. And I really don't even want to go to work. And so they actually walked me through it. They came up with something which I should have thought of myself. They said, you can always own the business without running it. You just find another CEO to run it. And I said, hey, why didn't I think about that? That's a good solution. And they said, it'll take you 6 months to find someone, put a smile on your face, go to work every day. You know it's ending in 6 months. And I did that. And in a few months, we found a guy who was really excited to run the company and gave him incentives and all of that. And I moved on. And then actually just a few months, maybe he was only there for about 2 months. And he called me and said, someone wants to buy the business. So he had relocated. He had relocated from Dallas to Chicago. And I didn't want to pull the rug out from under him. So I said, what do you think we should do? He said, oh, sell it. All his options and everything were going to vest immediately on change of control. And so he was going to collect what would have taken him 5 years or 2 months of work. And then the people who were buying the company, they wanted him to run it. So they were going to give him a new package. So for him, it was a no-brainer, just sell the business. And for me, I really didn't have any great love for the business. I said, okay, I'm not. And the best part was they were not looking at me because I'd already left. They were not looking at me to run the business or be involved in any way. All they wanted for me was a 5-year non-compete. So I said, look, I can give you a 50-year non-compete. Can we just increase the purchase price? Because I was so sure I would never go back into the IT business. They didn't have any sense of humor about that. They said, we want 5 years and that's it. So basically, I got cashed out. My CEO went on to run the business. It's still running, actually. The company is now 31 years old, still running. And I haven't been involved in it for 23 years or something, 22 years. So that's a little bit about what I would suggest is the 2 or 3 frameworks are like I said, control is overrated. When Buffett bought Coca-Cola, he didn't control the company, still doesn't. But like he says that sometimes he used to host these MBA students and he do sessions with them and he tell them, look at the back of the room, we have some drinks for you, Coke products and so on. He said, I really don't care whether you drink the Cokes or not, but just open the can. And his thing was that every 8th can that gets opened, the Coca-Cola company makes 1 or 2 cents per can. And then every 8th can, that 1 or 2 cents comes to Berkshire Hathaway. And so he says, it doesn't matter whether you drink the Coke or not, just open the can. And all he does is counts how many cans get opened every day. Life is good. So I think with that, maybe we can switch to what you have in mind and take it from there.
Great, thanks. I really enjoyed the humor that you bring to this. This is a new one for us, not the side of you that we know. I'd love to hear a little bit more about asymmetries and the concept of decoupling risk and reward that you speak about, specifically in the context of entrepreneurship.
Yeah, so I think in general, basically, we know this. We're all running businesses. Many of you are founders. Just the nature of successful entrepreneurship is you can take a very small amount of capital and convert it into a very large amount of capital just because the venture takes off. And you sent me some names of some of your companies, the Kapoor watches or the Amber Enterprises and so on. The thing is, these businesses were small embryonic businesses that didn't take that much capital to get going. And we see that all the time in entrepreneurship. On the other hand, you can also have failures. The maximum you can lose is what you put in. So you can't lose more than 1x what you put in, but you could make 10x, 50x, 100x of what you've put in. And the same thing applies on the investing side, right? The most you can lose is what you put in, and the most you can win could be infinity. So I think that asymmetry is what is very helpful and what I've found useful, because I'm not operating Pabrai Funds as a business, but I'm not really operating a company with lots of people and operations and all of that. So when I allocate capital, what I'm looking for is the same thing an entrepreneur is looking for. I'm looking for a high asymmetry in returns. And one of the things that happens in the public markets is that because these are auction-driven markets, it's like the horse racing pari-mutuel system. Auction-driven markets tend to overshoot and undershoot. So for example, if you own a luxury apartment in Gurgaon, for example, and you ask your realtor friend, real estate agent friend, what is my apartment worth today? And he'll say, oh, it's worth 10 crores. And you say, okay, that's great. And then you go to him tomorrow and say, hey, what's my apartment worth today? He'll tell you it's worth 10 crores. Then you go on the third day, he'll say, listen, idiot, it's still worth 10 crores. Okay. And if you keep going to him every day and you ask him to tell you what your apartment's worth. Maybe after a few months or a year, he'll tell you it's worth 12 crores, for example. It's gone up or something. But if that same apartment or group of apartments were a listed business, listed on the BSE, NSE, etc., what would happen is that if that market cap was 100 crores, for example, at some point, and you looked at it over a course of a year, it would vary from 60 to 120 crores. Okay, so the fluctuations in the value of the underlying asset would exceed the amount by which the underlying asset is changing by quite a margin. And this would not happen if that business were not listed. If it were a private company, for example, 100 crores has some apartments rented in Gurgaon and so on. If someone wanted to sell that, there's a bunch of intelligent buyers facing an intelligent seller. They would arrive at an intelligent price, and that transaction would take place, and that'd be the end of it. But in the public markets, you could buy potentially the 100 crores of real estate in Gurgaon for 70 crores, or you could even pay 130 crores. It could go both ways. And so the fact that things can get mispriced is what pays the bills for me, right? And in some cases, the mispricing can be very extreme. And so then that can really do wonders. And so you see that range with the public markets and gives you the asymmetry. And with the entrepreneurship, that really in the early stages of your business, because just the amount going in versus what you're getting out is huge.
Great, thanks. So that kind of plays in a little bit with the Mr. Market philosophy as well. You know, when we speak about the mispricing of listed assets or publicly owned assets. The other part which you speak often about asymmetries is this concept of heads I win, tails I don't lose much. I hope I've said it right. You talk a little bit, about that.
Yeah, I mean, I think that's just as classically how us entrepreneurs think about everything, right? People think that entrepreneurs take risk. They always think that business people take risk. Actually, we don't take risk. We do everything in our power to minimize risk. And so to an outsider looking in, it looks like we are taking risk, but we aren't really taking risk. So for example, when I was leaving my job and I was starting my first business, I was going to lose my paycheck and I was going to be dependent on the business taking care of me. And to an outsider, that would look risky. But what I had done is I started working on my startup about 10 months before I quit. And I was 25 years old. It was actually my third startup. So the first startup, which I had when I was 22, it probably lasted about 4 weeks and it probably cost me like $300 and it disappeared. And that had no downside for me. The second one, which I had two other co-founders, we were all working, but we were trying to get a software tools company off the ground. That probably lasted like 4 or 5 months and maybe cost me like $1,000 or $1,500. And that went by the wayside. Nothing happened, and that money was lost. And the third startup, which I did myself when I was 25, which was TransTech, basically, by the time I quit my job in 9 months after I started, the business already had clients. It already had cash flows, and the cash flows were exceeding what I was getting paid. And I was working like probably 80, 90 hours a week, and I was desperate to go full time into that business and work 100 hours just on that business. So when I quit my job, I had a good understanding of the risk profile. So I said, okay, if this business fails, what happens? So I had $30,000 in my 401k, which I had pulled out and I was investing in the company. So I said, okay, my $30,000 goes away. I'm 25 years old. Retirement is like 35, 40 years later. I can take a job and rebuild that, not a problem. Then I had also taken all these credit cards, which I was going to borrow from the 70,000. And I had researched US bankruptcy law. At that time, the laws were a little bit different. They've changed them now. But basically, if my business went bankrupt and I couldn't pay that 70,000, a court in the US would wipe it clean. They would basically look at my situation and they'd say, okay, your debts are forgiven. Now, the way bankruptcy law worked in the US at that time is if you filed once personal bankruptcy, you couldn't file for 7 more years. So you actually became a very good credit risk after a bankruptcy filing because you couldn't file again. And so actually anyone was willing to lend you money. They just said, okay, this guy, he wants a car loan. The car loan is for 4 years. He can't file for 7. We're fine. We can make a loan to him. And so actually it was very helpful. So I said, okay, this 70,000, if I'm not able to pay it back, what I'm going to do is I'm going to shut the company and go back and find a job. And I was an engineer and I thought I could find a job and all of that. So finally, when this company had some traction, I went to my boss and I met him and his boss and I resigned. And they basically said, Mohnish, we couldn't really figure out what was going on with you for the last 9 months because suddenly your performance had dropped considerably. I said, look, what I did 9 months ago is I decided that a career path or getting great reviews was out the window. I didn't care about that. What I cared about was not getting fired. So I said, what I did is I took my time in the company down to just above firing level. He said, the funny thing is we discussed this several times and we said something has changed, but he's not so bad that we can fire him. But somehow the magic is not there. So I said, exactly. I was just trying to be above firing level. And so they said to me, look, when your business fails, they didn't say if your business fails. They said, when your business fails, you come back, you got higher pay, you got a promotion, everything. We want to have you back. So I said, this is even better than I thought. Basically, when the business goes under, 1 day later, I'll have a job. I don't need to, and I'm getting paid more and all of that. So I said, this is wonderful. So where was the risk? There was no risk. The risk at the end of the day was $30,000 in a retirement account for a 25-year-old who was single. And I knew that at some point I'm going to be married and I'll have kids and all of that. And at that point, these things will become a lot more expensive to try out. And thankfully, that business never failed. And I kept in touch with my boss and his boss. And 10 years later, they both became investors. So it was very funny. I'm still in touch with them. They're very old. But anyway, so I think that the heads I win, tails I don't lose much. I think if we go back to the beginnings of many of your businesses or many of the businesses your parents may have started or father may have started and so on, you'll find similar dynamics. They didn't have any money. If you don't have any money, how can you have any? There's nothing to lose. So by definition, it's a low risk proposition. And then once the business gets going, it's just got its own momentum and takes it from there. So it works out.
So this kind of reminds me of the part in your book, Dhandho, about the two parts about the Manilal Dhandho and as well as the part about the motels. Would love to hear your thoughts about any one of those two stories, for the benefit of those who haven't had the opportunity of reading your book.
I think that when I wrote the book, the Patels owned something like 40% of all the motels in the US. And now I think that number is over 70%, 70 or 75%. It's moved. The book came out about 15 years ago. And they've gone upscale. So now a lot of Hiltons and Marriotts and Westons are under Patel ownership and they've gone into other businesses. So, there are about 3 or 4 million Indians in the US. And probably something like 500,000, 500,000 or 600,000 are from the state of Gujarat. And probably maybe 200,000 or 300,000 are Patels, something like that. So Patels are something like 0.1% of US population. And a group that is 0.1% of the US population controls 70% of the motels in the country when they were not even in the country 50 years ago. And did it with no capital. They didn't come to the country with a lot of capital. So theirs was a classic case of Dhandho with heads I win, tails I don't lose much. Because When they came to the US, at that time, they came as refugees, got thrown out of Uganda, and all their businesses got nationalized. And all they could do was they converted some few $1,000s into gold or something, got it out of the country, and came as refugees to mainly the UK, the US, and Canada. And the motel business was very attractive because it gave them a place to stay. The family needed a place to stay. It gave employment to the entire family because they could put the kids and the wife and everyone to work on manning the front desk. Motels are very labor intensive. It's really, you need people 24 hours. Someone has to man the front desk and someone has to do the laundry and clean the rooms and all of that. So the family would move into these small motels, take 1 or 2 rooms, and then they would fire all the staff and they would do all the work themselves. And they became the low-cost operator because they looked at every facet of the business and they looked at how can I reduce costs. So first way they reduced costs was there was no payroll. The second is that the Patels were all vegetarian. At that time in the US, if you're a vegetarian, you were man without a paddle. There's hardly any places you could eat out and get a decent vegetarian meal. So they were forced to dine in, cook their basic vegetarian meals and eat. So there was very low grocery expenses. There was no rent. There was no commuting. You didn't need a car. So all their expenses were very low. And they ran the motel, all of the family. And they would just look at what the other motels around were charging. If someone was charging $35 a night, they would make it $32 a night. And so their occupancy levels were always high. And the other people couldn't match their prices because they would lose money because they had employees and costs and all these things. And what the Patel started doing is they used a lot of leverage because these were non-recourse loans with the motel. So they would then buy the second motel and then send some cousin to run the second motel and then buy the third motel and then keep going. And we end up with this compounded journey today where they've done extremely well. And it's worked out really nicely for them. And a lot of that dovetails with many of the journeys you guys have had. As entrepreneurs, we do that. That's what we do. So.
Great. Thanks. I'm going to introduce Ayush Munjal now, who is the champion of the investment, My EO FinServe. Ayush has some questions for you.
Hi, Mohnish. Really loving this atmosphere of chatting with you so casually, sitting at home in what looks like your library and, casually discussing 70-80% growth in your IT business that you were bored of and you just wanted to start investing on the side. So I think many of us would kill for that kind of growth in our businesses. I'm going to ask you 2 questions. The second one is optional. The first one is, what's in your room? I see a bust, a painting. I see 5 or 6 bookshelves. What makes you at home? The second question, which is more serious, you've talked about control is overrated. What are the tailwinds you are left with, if not control of your business? I'm phrasing it a little, weirdly on purpose, so you can, answer the gist of what I'm getting at. You're delegating control, or you're becoming a passive investor like Buffett or like Pabrai, you select businesses. But what do you look for in that selection? I'm not asking for your current portfolio, but more of your thought process on what are you left with, if not control.
Okay, so before I answer your question, you have a prominent last name. So are you with the Hero Honda family?
Yes, with the family. My business is separated now, but yes,
Yeah.
You've got it right. You probably know a few of my uncles.
I just read the book, that I think one of the kids wrote.
Yeah,
he's not a kid. He's not a kid anymore.
He's not a kid anymore.
Yeah, but I really enjoyed. And
that
actually,
was my grandfather and his brothers. Yes.
Yeah, and I think I really enjoyed that story, and I think it's a Dhandho story. It's a classic.
It is.
So it was really wonderful to read it. I really enjoyed the book, by the way.
It's a compliment coming from you.
I would say that I moved to Austin about a year ago. I used to be in California. My home library in California had exploded. The number of books were way more than the bookshelves I had and all that. So they were like all over the place. And so what I did when I moved to Austin is I basically remodeled the home a little bit that I bought, and I basically tripled the size of the library. And so what behind me is probably like 20% of it.
Wow.
And so it goes around. Basically, instead of having a library room, what I did is I made the external walls of one of the rooms all bookshelves.
Okay.
And yeah, I think I'm good for a good 10, 20 years with the book, so I should be okay.
What are you reading this month?
There's a really wonderful book I'm reading, which is called Roy Thomson of Fleet Street.
Okay.
And it's not an easy book to get. It's out of print.
Okay.
There's actually 3 books on Roy Thomson, so I actually got all 3. And I'm just finishing the first one. It was just fantastic to read. And anyway, this guy basically ended up owning something like 300 newspapers and a lot of television stations. And he was like broke, basically. He had no money. And so that journey, just this incredible journey he went through, was just wonderful to read. So I enjoy business biographies the most. I think that's, to me, the autobiography and the biography, my favorite genre. And in fact, the books to my left, you can't obviously see the titles, but that bookshelf, that part of it is only biographies, business biographies. And so those are wonderful to read. I want to tell you a story, which is probably one and done, but just to highlight what is possible, is I started making trips to Turkey, Istanbul, about 4 years ago, and 4.5 years ago. And I started doing that because the market has dislocated a lot. Turkey has very high inflation. The currency devalues like crazy every year. And foreign investors had left. And when I just looked at it optically, it looked really cheap. And I had a good friend there who was a Buffett, Munger, Graham disciple. And I knew that he was investing in Turkey. So I said, listen, I want to come to Istanbul. Can we just go visit all the businesses you already have an investment in? And he said, oh, yeah, that'll be fun. It'll be fun to hang out and this and that. And so I went in 2018. Then in 2019, I went again. And again, I went and visited some more companies that he had invested in. And I remember we were driving to a business he was taking me to, where he said, Mohnish, the market cap is $20 million and the liquidation value is like 800 million. So I said, fraud hai kya? In English, I told Haider, is this a fraud? He said, no, I have an investment in it, as far as I can tell. So basically, he said, there's no fraud. And he said, it's really simple. They have 12 million square feet of warehouses. They're 99% leased. You can very easily get a value on those. It's about $80 a square foot on average. So you have about $1 billion value of these warehouses, and there's 200 million of debt. And there's 800 million. And these are all leased to Amazon, IKEA, Carrefour, 99% leased, inflation index leases or dollar leases. And there's nothing there. So I went, and the father and son that run the business, I met them. I liked them. I thought they were really smart business people. And then I've spent the afternoon visiting the warehouses, and they looked great. And I really couldn't find anything wrong with the company. And I started buying the stock. And Turkey is a dream market to invest in, because the average investor, they don't say investing in the market, they say playing the market. So people want to invest at 10 o'clock, they want to exit at 3 o'clock, and they want to make 10%. Okay, that's their model for investing, and good luck with that. And I was surprised the volumes in the Turkish market are really high, because you've got this gambler type behavior. If you take out the promoter stakes and the international investor stakes, which don't move, the float in the market, which is about 20% of the entire Turkish market cap, turns over every 9 days. The whole thing it's on a very rapid, and local Turks told me we are surprised it's 9 days. We thought it'd be 1 day, because everyone wraps up every day. Wow. So Buffett has a quote. He said the stock market is a mechanism to transfer wealth from the active to the inactive. So I started buying the shares, and I was surprised. For $7 million, I got 1/3 of the company. And the founding family, actually, they were not very savvy on the stock market. I think they are now. They had about 35, 36%. So my stake is almost at the level of their stake. Now they've increased their stake. They're like 42 or 43%. And the second thing, what I noticed about this father-son that run this business, is that they didn't just have the warehouse business. They also have the largest freight train network in Turkey. So in Turkey, the rail cars are private, and you can run freight business and so on. They have the largest truck fleet in Turkey. They have 2,000 trucks. They have a huge forklift rental business. They have a vehicle inspection business. Every car has to go through inspections every 2 years. And that's like you get sanctioned by the government and so on. So they're like 4 or 5 businesses. Each one has very favorable economics. And each one is a high quality business. And so their model is that if they don't get their money back in 2 to 3 years in dollars, they have no interest in investing. So I found that unlike a lot of entrepreneurs and business managers, the father never went to college, but he just understands that if I put $1 out, he wants to know, ye dollar kitni der mein meko wapas aa raha hai. And if it's not coming back in 3 years, he's not interested. So he doesn't understand IRR. He doesn't understand return on equity. He doesn't understand any of those terms. He just understands this particular fact, which your grandfather understood.
Yeah.
He just understood this fact that I put money out and what comes back, and that's what matters. So when we invested in 2019, the company was worth about 700-800 million. At least it was probably worth more, but that's the amount I could figure out. I think the value now maybe about $1.5 billion. It could be more. And the stock that was a 20 million market cap is now like 350-400 million. So it's moved, this is in dollars. The lira has collapsed in the meanwhile. Right. And even with the collapse of lira in dollars, we're up a lot. But even at the 350-400 million, it's very undervalued. And the thing is that abhi wo kehte hain na hing lage na phatkari rang chauka. So basically, what do I have to do? Yeah. I have to be in Austin just reading whatever I want to read. Okay. Do I have control? No. Do I care about control? No. Do I want to be on the board? No. All those things mean I have to do work. My job is to just cheer them on. I go meet them once a year. I talk to them every few months. And they are very smart about how they invest. I've never seen them make a mistake. They're very creative. What I was telling you guys about the creativity, they have extreme creativity of entering new businesses, but they make it extremely tiny bets. So they'll see some opportunity. They'll actually go in where they don't have competence, put $500,000, $1 million, whatever, and they see what happens. If it works, then they just press on the accelerator and they go. And if it doesn't work, they back off and then try something else. So basically, Abhi, with this business, if it went to $1 billion market cap today, we're not selling. If it's gone to 5 billion, we're not selling. Because basically, if someone is reinvesting capital, 25-35% return, and this father-son duo pretty smart about doing it, I need to leave them alone for 20 years. So what difference does it make whether I'm the founder of the business or the manager of the business or a passive investor? The best position is a passive investor. Kuch kaam karne ki zarurat nahi, right? And your grandfather worked very hard. Your uncles worked very hard. Everyone worked very hard. I just not that hardworking, So I think that there are, because of the auction-driven nature of markets, something like this Reysas in Turkey will show up once in a lifetime. But you only need one. You don't need 10. But there are plenty of them that show up, which will give you a 10x, give you a 20x. Reysas might give us 300-400. Eventually, by the time we're done, it might be several hundred times the return. And all we got to do is be a cheerleader, nothing else. And life is good. So I think that's how I look at it. Is I think that like this year I made a resolution. I said that I really want to deeply study 50 businesses. So far it's January 10th. And I've only deeply studied one new business that I didn't know about on January 1st. And I rejected it. But it was a good one to look at. It was a pretty decent business, would do well, but didn't excite me that much. So if I actually fulfill that resolution and I actually do deep dives on, and because when I say study 50 businesses, most businesses I look at, I get rid of them within 5 minutes. So I don't consider those as part of that equation because they have to have high returns on equity. They have to have runway. They have to have great management. They have to have all these things before I'm willing to spend time, right? So usually you look at a business, return on equity is low, you can forget about it. So that doesn't count. It's ones that make it past 1 or 2 hours of screening or 3 hours of screening. And then you say, okay, let me go deeper into it. So if I can do 50 of those in a year, my hope is I find one. Right. And then
what do you look at? I mean, where do you get all this information about a business? I mean, to read 50, you must be discarding 500. Where do you get all of these data points? You have a team that sends it to you. You have friends who send you pitches.
Okay, no, the thing is you don't need a team for doing this. For example, in the US, we have something known as 13F filings, which are basically every quarter, large investors have to disclose everything they own. You have something similar in India. What main investors own is well known. We want to know what R.K. Damani owns that's available, publicly available. He owns a company called VST Tillers in Hyderabad. They're a tobacco company, licensed to print money, Will cigarettes, etc. So what I'm saying is that I can look at what Buffett's bought last quarter. I can look at what number of great investors have bought, and I can put those into the hopper and say, let me study these, for example. I can also have some notion. So let's say if I look at India, okay, and India is going to go through a lot of growth in a number of different areas. One area that's bound to grow a lot is wealth management and asset management. All of you probably either have wealth or asset managers or are getting hounded by them or whatever else, right? It used to be there were three choices. The money went under the mattress, or it went into real estate, or it went into gold. One of those three, right? Now people are not so interested in real estate, definitely not so interested in gold, and the under the mattress is also not that interesting. And so a lot of these, the wealth creation and even the existing wealth will end up in financial assets. They'll end up in stock, bond, mutual funds, and all of that. So if I look at people who have the large mutual fund houses, there are like 4 or 5 of them that have most of the assets. Some of them are listed. In some cases, even if their valuations look optically expensive, the runway is so big that I could pay 20 times earnings for something, still work out well, because that business, that's the business I'm in. So I know that the return on equity is very high. You don't need any capital. You have a few people, they are highly paid. But when the people leave, the assets don't leave. Like IIFL got 3 or 4 senior guys from Kotak when they started their wealth management business. Those 4 senior guys could only bring with them 15% of the assets they managed. 85% stayed with Kotak even after these guys left. So the brands have staying power even when the name brand individuals are leaving, right? And I can see that, right? Because that's a business I've been in for a long time. So for example, that's an area of interest to me because I said, okay, let's scan the radar on the Indian asset managers, wealth managers, and see what's going on, right, with them and see which ones. And probably the answer is you could buy a basket of all of them and do that. And control की कोई problem नहीं है, वो रामदेव अग्रवाल को चलाने दो, वो अच्छी तरह चला लो, no problem. What do you say, Mudit? Are you a fan of Ramdev?
Yes, I think all of us are. In fact, Motilal Oswal is the sponsor of our chapter.
Yeah, so they've got tailwinds, they've got high return on equity. We want to get it at a reasonable price, and then the rest is just leave them alone and be cheerleaders, and don't touch it for 20, 30 years.
I want to invite some members to ask their questions directly to Mohnish, if that's okay. Rishi, can you join us on screen?
Hi, Mohnish. Can you hear me?
Yeah.
All right. So I have a couple of questions. One is, how do you see the Indian market performing in 2023, looking at what's going on in the world and different markets and challenges it has? Second question was around, if you were to start investing overseas in 2023 from India and looking at long term, where would you invest?
Yeah, so actually, I never really have a view on markets. I have really no idea what markets will do. I think it's very hard to just figure out what the trajectory of one business is going to be. Okay, so to try to figure out the trajectory of 500 businesses, that's just a fool's errand. There's so many factors. If you looked at 2022, start of 2022, who would have thought the Ukraine invasion would outlier event that comes out of nowhere? COVID is still with us. It's been 3 years, it's still with us. And so all these things are difficult to figure out. So there's no point spending time on them. My take is I want to just figure out particular businesses and what the likely possible trajectories on those businesses, and if I can do something with. I think your second question is an interesting one, because what I notice with a lot of wealthy Indian families is that if they are business family, basically the wealth is in the business, it's in real estate. Now it might be in some financial assets a little bit, and that's the end of it. But now you have permission from the government to send money out, which is great. So I think if you were going to put something like a fourth of your family wealth into something like the S&P 500 index, for example, which would be a low-cost approach to doing this, that's a good thing to do. So you don't have to think about it too much. You will own pieces of Amazon and Microsoft and Salesforce and all these great businesses, and those churn very slowly. And all of those have great runways ahead. And you don't have to do much work, and you can get that done for 10 basis points or something. So the cost is like 0.1% a year or something. So that's what I would do. I would just look at a broad index like that. And then since you're averaging it out over time, it doesn't really matter what happens. Market goes down 5, 10%, whatever. That's not really relevant. You're looking at this over the long haul. So that should be okay.
Great. Our next question is from Ayush Singhania.
Hi, Mohnish. So World Bank, in fact, recently, maybe I think it's today, they've announced that, 2023, we're close to global recession. What's your view on that? And especially what's your view on what effect could that have on India, on the Indian markets?
I would just say similarly, I have no idea. I have no idea whether I would say that it's likely India will do well. I think India just has a lot of tailwinds going on, and I think a number of things are just going in its favor. So it'll probably do well, but I don't think about it like that. Right? So I just look at specific businesses. And then I say, okay, this particular business with this particular nuance, one of your companies is Kapoor Watches, Ronak Kapoor. I never heard of Kapoor Watches. I'd like to know more about it, probably a private company. So no chance for me to do nothing about it, but that's okay. But what I'm saying is that you look at something like Kapoor Watches, and what do they do in the next 1 to 5 years? All these factors, international and COVID and recession in US, whatever, is really irrelevant. It's in the noise level. What really matters is how well do they connect? What is their products and brand positioning and all those sorts of things? Do they engage with their customer base and so on? And so I think that's where the focus needs to be. We had a great Indian investor, Rakesh Jhunjhunwala, who passed away recently. And Rakesh was an interesting split brain. On one side, he was always with 4 screens in front of him and did a bunch of rapid fire trading and all kinds of stuff. On the other hand, he had some positions that he never touched for decades. I think he had Titan for 25 plus years. And Titan used to be like 4% of his portfolio. When he passed away, it's like a multi-billion-dollar position. So Rakesh could have been wrong on 96% of his portfolio. 96% could have gone to 0. He still would have had half his wealth. And he would have had half his wealth so he never managed money for others. He never, until he started this Asaka Air or whatever, he never really had a real business he was running. And that non-controlling interest in Titan, he loved the Tatas. He just loved the governance and everything else with the Tatas. Ended up with a great result. And all he had to do was just be patient and do nothing. And it worked. So basically, we don't need to be right a lot. We just need to pay attention when 7 moons line up. So there are times when you look at some things and you say, wow, this looks amazing. This is obvious. This is whatever. And you can step up and hit that ball. And you don't need to hit too many balls, and you don't need to have a high hit rate on those. It can work out pretty well.
Samyak, you want to go next?
Hi, Mohnish. Quick question. You have a lot of books in your library. Which are your favorite books related to investing?
The favorite book is the one behind Mudit. Mudit has the best books. You should go to his place. There you go. He's adjusted. So we don't see his face, but we see the book. So he's going to zoom in. There you go. So The best book I have in my library and the one I like the most is Poor Charlie's Almanack. That's the one he's showing you on his screen. And I try to actually reread it every year. And I think that book is better than a college education. So that would be my number one pick for you. And just to give you a quick synopsis of what that book is all about, at the back of the book, the second half of the book, is a bunch of talks and speeches that Charlie Munger's given over the years to various groups. One of those speeches, which he gave at Harvard, is the psychology of human misjudgment. So that speech probably took Charlie about 50 years of experience to actually be able to write that speech. And the good news for us is we can just read it in 1 hour or something and pick up that whole 50 years of experience without going through the journey. But to give you an example, so the thing is that one of the things to be aware of is that when you look at human evolution, the way we have evolved and here's where we are, is our brains are weird in the sense that there are portions of the brain that are really ancient. And there are portions of the brain that are relatively new. And it's a mishmash. It has come out this way because of the nuances of evolution. And a lot of it doesn't make sense with the way our brain is in the current context of how we live and how our world is. So just one example is through most of human history, humans were not ingesting enough calories. It was hard to get food and difficult to get enough food. So the body evolved, okay, whenever you get more food than you need, the body became really good at storing it. Now the body doesn't understand कि अभी हमारे पास refrigeration है और food की कोई shortage नहीं है. अभी Swiggy है, Zomato है, सब कुछ है. We will never be in a calorie deficit. But that the body is not going to adapt to that for almost infinite amount of time. So we are stuck with having overweight bellies and all these things because evolution doesn't understand that we don't need the bodies to function this way, but it's just the way it is. So one thing about the human brain is reciprocation is a trait that's built into the human brain. And they think it comes about from a long time ago because some humans lived in these small groups, 20, 30, 40 people. Some guy kills a big animal and brings it to his community. Now, he can't eat the whole animal himself and he can't store it. There's no refrigeration. So what does he do? He stores it in the bellies of his neighbors. He calls everybody and says, let's have a feast. I killed this big beast. Everyone has a good time. Everyone gets fed. And what they know in their brain is Suraj gave me a great meal today. And Suraj is a great guy. And someday I'll try to do Suraj a favor. Okay, that's all the brain understands. That Suraj is a good guy. He fed me today. So later, when I have success and I bring down an animal, I'll definitely invite Suraj. Right? Because he took care of me, I'll take care of him. So the brain has reciprocation built in because reciprocation enabled survival. And so the people who reciprocated were the ones whose genes got passed on. But there's a quirk in the brain with reciprocation. We don't have a calibration engine on the reciprocation. So what happens is I can remember that Suraj did me a favor. That's etched in my brain. I cannot remember the size of that favor. I just have a good feeling towards him. So salespeople and marketing people and business people take advantage of this quirk. I take advantage of this quirk. So for example, if someone contacts us and says they want to invest in public, interested. Now we can send everything digitally. We can send all the documents, everything digitally. But we don't just do that. What we do is we send the guy a package. Now this package has a $50 pen in it. Okay, it has a couple of books, it has a bunch of things. So the guy doesn't want the pen. Okay, he doesn't want any obligation with me. But only like maybe 1 in 200 people will return the whole package to me, saying, I looked at it, this is not for me, thank you very much, warm regards. The other 199 or so, it's too complicated to return the package. Takes too much work. So what ends up happening is they have been given a pen that they are not able to throw away, and they use that pen. So they have favorable perspectives towards Mohnish because Mohnish did them a favor. Now, to return the favor, the minimum investment is 3 million. So, because that's how reciprocation works. And so the thing is that this notion of the asymmetry of reciprocation, which our brains are not able to comprehend, and what you want to do, you want large portions of the world to have good feelings towards you. You want them to feel like they owe you something. And then the way they would reciprocate that would work out in your favor. So this is like one of the mental models. Like so in Munger, the 25 causes of human misjudgment, there are like 25 models like that, 30 models. If you actually understood and used those models, and especially when you overlay models, you get a huge advantage over the rest of humanity. The cloning is a model, which is a very powerful model. The not having self-pity is a model. So there are like many models you can use. It'll improve your personal life, improve your business life, improve your career. So Poor Charlie's Almanack is a great book to read.
Okay, I think it's time for us to wrap up. I just want to read one little thing, and then I want to hand it over to our president. This is from the book Richer, Wiser, Happier, which says that by William Green, the chapter about Mohnish in there, which says, nobody I've ever met lives more determinedly by his own rules than Pabrai. Buffett's example strengthened his commitment to construct life congruent with his personality. On a typical day, Pabrai sleeps late and arrives at his office after 10 a.m. with no agenda. Today, Mohnish joined us at 9:30, which is significantly before 10 o'clock, and I'm really grateful. Thank you so much. I'd like to introduce our president, Nimish Arora, for the vote of thanks, please.
Hi, Mohnish. Thank you so much for an amazing session. Before I say thank you, I would also take the opportunity to ask one question to you. And somewhere I think in one of the videos or somewhere I heard that there was a psychological test you took sometime early in the start of your, or rather when you were probably transitioning or considering transitioning from your business to investment, to figure out, what kind of a person you are and how that led you to find your true calling. If you could just, throw some insights and maybe give us a perspective on how each one of us can sort of find our true calling or figure out, what we enjoy the most, because a lot of times, we are still figuring out that is this our true calling, what we are currently doing, or we want to do something else?
Yeah, I think, Nimish, that's a great question. So this was in 1999, and it was at our forum retreat, at our YPO forum retreat. So one of the guys basically said that there are these two industrial psychologists, and they're going to do basically a 360 analysis of each of us. So what they did was they had us take a bunch of tests, and they talked to our employees, our friends, our spouses, our siblings, and if the kids were old enough, they talked to the kids as well. And so they did interviews with all these people, plus they did all the tests. And what the output was is what I call my owner's manual. They pretty much, and what we did, so we did all this before the retreat. Individually, we engaged with these two guys. Then at the retreat, the two of them sat with us for 3 days, and they one by one, they went through each person. And basically what I think every human, the problem is that when we're born without an owner's manual, like Hero Honda sab proper owner's manual deta hai sabko, humko kuch nahi mila. And basically we really don't understand for the most part who we are, because we are so influenced by what the world expects us to do. So human behavior will be driven towards, okay, I should go to college, I should become an engineer or a doctor, I should do this and that. we follow these paths that have been prescribed to us. And those may be very different from who we are. So what this owner's manual did, and I actually reread this every year just to make sure, is they highlighted who I was, which I never knew. And the two guys actually who did this for me, they actually told me that in my particular case, they said, look, you like to play games. That's who you are. You're a game player. But you don't like to play any particular, you don't play any games. You like to play particular kind of games. He said, you don't like team sport. So like, for example, I would not enjoy playing soccer because he says the outcome of that game would depend on the whole team. He said, you're more of a guy who would enjoy like table tennis or tennis, more individual sports than team sports, right? And then he said, there's a second quirk. You like to play games, but you like to play games where you think you have some odds where you can win the game. So they were looking at me with my 200 people in the IT business, and they said, we don't even know how you go to work every day. This is so far away from where you are that this is ridiculous. And I was, at that point, I was just about to start Pabrai Funds, and I was just about to leave my business and all of that. And I showed them what I was going to do with Pabrai Funds. And it didn't exist at that time. It was about 3 months before it launched. They said, this is perfect. This will work really well for you. And one of them became one of my initial investors. He was, at that time, he gave me 100,000. So I told him, I said, Jim, look, I gave you $2,000 for this, and you're giving me 100,000. I don't want to lose your money. Okay. He said, no, I cracked your brain open. Everything's going to be fine. Please take the money. Okay. And he did fine. There's no issues. And so the two guys have split up now. Only one guy does this. And I think the $2,000 is now about maybe 10 grand or so. And last I checked, but still a bargain. I think it's a great deal. So what I'll do is I'll send, his name is Jack Skeen. I'll send his contact info to Mudit. And I think a lot of it you can do remotely because of Zoom and all that. I get nothing whether you do it or not. I have no kickback or anything. But I would say that it would be, I would say probably the best 10,000 you could spend. And I think all your kids should do it in there. I think it would help them a lot as well. So that's a great question, Nimish, and I'll get Mudit the info.
Awesome. Thank you so much. Thank you for your time. Thank you on behalf of EO Gurgaon and all the members who've joined from different chapters. Dhandho was an amazing read, and I would recommend each and every person who is here to read it if they haven't. I would also take the opportunity to compliment you for the work that you're doing with your foundation, Dakshina. I think you're doing some amazing impact work with the underprivileged and, turning lives, not just for them, but for their families. So really my compliments to you, and more power to you for that. Lastly, thank you for this amazing insights. I have taken lots of notes. It's amazing to know how your YPO forum has helped you evolve and, come this far and find your true calling. And I think EO has had that impact for a lot of us already. We've been part of forums now for 3, 4, 5, 7 years. And thank you again. I think loads to take for everyone home, and we look forward to hopefully hosting you sometime whenever you visit next to India at our chapter or one of our events.
Yeah, I would have actually liked to do this live. It would be more fun, but this is not a bad option. And I would love to meet all of you. So maybe sometime in the future we can do a live event. That'll be fun.
Thank you so much. Thanks for your
Thank
time.
you.
I know we overstretched, but appreciate your time again.
All right. That's wonderful. Thank you.
Thank you.
Bye.
Bye-bye.
Bye.